Behavioural finance studies tell us that the biggest destroyer of wealth is our emotions, and whilst we might like to think that we make decisions using our heads, when it comes to our investments, it's our emotions which drive our decisions more than any other factor. To have a successful investment experience, it's really important to remove those emotions from the equation. Many years ago, Bloomsbury decided to manage client portfolios on a discretionary basis, which means that we don't need to ask permission to execute trades on the accounts before we execute them. This has obvious administrative efficiencies for us, but we also felt it was crucial in terms of our clients having a successful investment experience. We educate our clients about what to expect over the years that they will be invested. We tell them that there will be bumps in the road and times when they feel uncomfortable. And it is really crucial that during those uncomfortable times they stay the course. Having the discretionary investment mandate enables us to help them do that. We really saw this put to the test during the credit crunch of 2008-2009. In September 2008, we saw a very sharp fall in the markets. Now, while the vast majority of investors were panicking and piling out of the markets and moving into cash, I was actually doing exactly the opposite with our client portfolios. I was selling the defensive assets, which had remained stable or gone up in value, and buying more of the equity assets, which had fallen in value. And I was doing that purely because the portfolios needed to be rebalanced back to the asset allocation models that we were managing them to. We saw a small uptick and then another sharp fall. So again, I'm selling defensive assets, buying more of the equity assets. Another small tick up and another sharp fall. So for the third time in almost as many months, I'm doing the opposite of what most people in the markets are doing. I'm buying more risky assets and selling the safe defensive assets. Now, if I'd had to ask our clients permission to do that beforehand, they wouldn't have felt comfortable giving me that permission, I think, in many cases. I'm not saying it was entirely easy for me to do. I know all the client families behind the money, and I knew that they were going to be worried and feeling uncomfortable during this period. And what we saw in early 2009 was the market start to turn upwards, and all the people who'd bailed out during this downturn weren't in the market when the upturn happened, and as much as the market fell quickly, it also rose very quickly. So the people who were out of the markets lost out. We weren't out of the markets. We had the right asset allocation for our clients. So as the market climbed during 2009, now I'm selling the risky assets and banking the gains that we made because we bought the assets cheaply coming down. So by the time we get to here, markets have recovered back to where they were. Most investors have lost money. They bailed out during the falling markets. They missed the upturn because they didn't feel comfortable going back in, and it happened so quickly they missed it. Our clients, on the other hand, not only got back to where they'd been, but actually were ahead of the curve at the end of this process because we had bought the assets cheaply going on the way down, and we banked the profits on the way back up. So during this period of time when things were really distressing, it was absolutely essential that we stuck to the course and we maintained the asset allocation of the portfolios. And I honestly believe if we hadn't had that discretionary investment mandate, we wouldn't have been able to do that for our clients.